Good evening, everyone. Thank you for again joining in. My name is Stephen Bauer. I am a financial planner and portfolio manager here at Evergreen Financial Group, and I'm excited to be talking with you guys all today. I am a certified financial planner professional, as well as an accredited investment fiduciary professional. Basically, I specialize in one-on-one personal financial planning, as well as the management and execution of our portfolios here at the firm. If you're joining us for the first time today, Evergreen Financial Group is an independent, comprehensive wealth management fee-only firm. We specialize in helping Christian families who love the outdoors, but we also work with many people from all walks of life, from young professionals to current and future retirees, as well as church staff members. We reside out here in the Rocky Mountain region, but we work with clients virtually across the US. So today we are going to be talking about a topic that's going to be more relevant than ever. Basically, it is how to build wealth and stay financially resilient in an uncertain economy. I'm pretty excited to go through some of these strategies here today. But before we jump into the presentation, I do have to just go over this disclosure. This presentation is for education purposes only and should not be construed as personal investment, tax, or legal advice. If there's any questions that come up during the webinar here, we'd welcome you to reach out to us for more in-depth conversation on your personal situation or circumstance. If you are a current client with us, please reach out to us directly and we can discuss how these strategies, which I'll be talking about today, may apply to you directly in your situation. Otherwise, please consult your tax or legal advisors for those issues. So let's jump into things. Going through things today, I mean, we can look at it and say there's few things that are in life that are certain. However, one of those things is economic certainty. It sounds contrary, but the certain thing about uncertainty is that it's going to happen. Personal finance by itself is a topic that can be uncomfortable to discuss, let alone adding in all the uncertainty and news we're hearing out there in today's world, whether that's inflation, interest rates, tariffs, tech stocks, or AI, artificial intelligence. There's a lot of jargon that goes through people's minds and social media feeds and all of these things that make you tense up when you hear these types of words. I mean, not to mention all the talking heads on the news or social media influencers promoting every type of shortcut that will make you rich quick. So, with all these different things going around, it's like, who do I listen to? Who do I believe? The goal of today's presentation webinar is to cut through the noise of it all and talk through some stable strategies that are tried and true, no matter how certain or uncertain markets are. So I have 5 strategies to cover today. And if you don't know where to start or know maybe a few things about money, my goal for you today is to walk away with at least one of these strategies to implement after leaving today's meeting. So let's talk through the first strategy. And the first strategy I have for you guys is to focus on what you can control. I know that can be difficult to think about, but that's going to be a big point and really the baseline of everything today. So nothing's going to cause us more stress and anxiety than trying to change something we really have no control over. We can't control if stock market goes up, if it goes down, what the next inflation data point is going to be, or the affordability of that house down the street that you're really looking to purchase. But we can control our response, and that's incredibly powerful. What we do in the face of these situations really will have long-term effects, not only in your current financial, situation or state of being, but also can last a lifetime. One of the most important factors to understand when it comes to the stock market is understanding that we can't control market movements. We only control how we react and how we respond in the face of all of those things happening. I mean, it's easy to build wealth when your investments are just going up and up, right? I mean, you see the green in your account and things are going well, especially with the, stock market up until the beginning of this year. We had a pretty big jump in percentages. However, it's not as easy when things are not going your way. When markets are down, when you log into the account, when it's red, when you don't feel like you have enough money to get by to the next month, paycheck to paycheck. So the first step in this, though, to get practical, is to really reassess what matters most. Now, this will look different for each person. However, this is really the first step in establishing your total financial picture. Really, is buying the boat you've been wanting the ultimate goal, or maybe that new car, um, whatever that could be, is that really the ultimate goal, or is that only a short-term goal in the long-term scheme of things? When we work with our clients here at Evergreen, we like to find out the important things that matter to them and build the plan based off of that. There's ultimately no wrong or right answer here, but it's important just to have an answer on the most important thing to you. So, really, what does that look like in a practical sense? So, the first thing really anyone can do that's listening here today is really to start planning. Planning is a word used a lot in the financial space. If you've been around finance or working with any type of financial advisor or planner, you'll hear it quite a bit. And the reason is because having a plan matters. It's really the backbone of our finances, because that is really where we can look at and to see if we want to make decisions X, Y, Z or not. So if you sit down, plan out your expenses over the next 3 to 6 months is a good step. This will really help you determine where your money is going now and where you're expecting it to go in the next, few months. Really, what that can do is you can find opportunities to say, hey, maybe we don't need that. Maybe we can wait a little bit on that, or maybe, spend the money somewhere else to decide if you really need to make that expenditure. It really helps you put into big perspective how important, some of these things are. Along with that, I mean, similar, it could mean postponing some of those big purchases. Maybe that's the vacation you guys are really wanting to take. I know I would love to be in Hawaii right now, but unfortunately, it's just not as doable as I would like. So I'm making the room for it to be able to make those things happen future. But if you're stressing about how to make it happen, that's when it may be wise to push it a little bit or create a different type of plan in order to get to that place. Even the fact of things such as cooking at home instead of eating out can have really long-term impacts on your portfolio, even if it's only say a couple dollars a day. You may respond to that and say a couple dollars a day in today's economy, how is that really going to make a difference? Well, the difference is because this creates the habits in you that are going to last a lifetime if you're going to start those now. What happens over time is hopefully your income starts to go up a little bit over time, the more you're in a role or the more experience you get. But what tends to happen is our income goes up just as much as our spending goes up. So usually what this is called lifestyle inflation. Many of these expenses are spent really just because we have the money and because the money is burning a hole in our pockets because we're making more. So we say, hey, let's spend a little bit more. Now, don't get me wrong, I'm not saying you can't spend money on the things you enjoy, but many times we can think twice about some of these expenses we have and things we are spending the money on. Ultimately, this goes back to the original factor of determining and reassessing what is the most important thing to me right now. If you're able to make some of these changes to spending now, this marginal impact you see will only compound over time. And so those couple dollars, if you invest them or if you're able to save them in a high interest account, will really build. And then when you're making more money down the road, they're going to compound even more. At the end of the day, it really comes down to taking control of cash flow and not letting it come control you. Being proactive about the money you have coming in will only help. Thinking ahead and being prepared for fluctuations of the stock market is much easier to work from than a place of being in debt. You're working from a place of surplus, you're planning these things out down the road, then getting to the place to say, oh crap, I'm in a really bad place. Being educated on how financial markets and economies move up and down over time can really help you better take advantage of the ups and downs and be prepared for the downs, especially. So, one example along these same lines is to really think outside the box. Is there something you can do now that can boost your cash flow? Now, this could be things such as picking up a part-time job. As we're coming up on summer months, there's several workplaces that are hiring seasonal part-time workers. Even if it's something you may not want to do, it could be just what you need to get over the hump. Another way could be to monetize some hobbies. If you love walking dogs, or if you just love hanging out with dogs, there's dog walking apps out there that you could download to create a little bit. If you have clothing and you enjoy lots of clothing, you could open up an online storefront. Or even picking up free furniture on Facebook Marketplace and refinishing it can combine a hobby as well as creating some income. As I mentioned before, even a couple $100s a month can really give you more breathing room and create that peace of mind that could be the boost you need to provide some stability in your life right now with all the uncertainty. So with that, let's jump to strategy number two. Strategy number two is basically to set manageable and attainable goals. Not only setting the general goals, but manageable, attainable goals that you can actually reach. When money feels tight, you know, that really is difficult to think about, as saying, hey, I'm just trying to get by day to day. And you're saying I should set goals. It may sound unrealistic, but this is really when they matter the most and can really make or break you going forward for building that wealth over time. Without clear goals, it's easy to get lost in the day-to-day stress. But when you define a target and write down this target, you give your financial decisions purpose. You have a clear direction of where you're going instead of wandering in the dark, hoping that one day you'll have enough money to meet your goals or retire or do those things you've been wanting to do. Sometimes it can be really difficult to feel like you're making any ground financially. But if you set goals that you can attain, you can monitor the progress of your efforts over time. Even more reason why goals matter is that they keep you grounded, especially when financial markets go up or down, or when you see inflation going the roof. You will make the changes necessary to meet these goals if you've established them already. You'll really think twice about making that next impulse purchase when you know exactly what you're working towards. For me, many of my impulses and purchases can come down to food. If I'm hungry and I'm out and about, or I can easily tempted to buy food, but especially when I get away from that burger spot down the street. I can much better control these urges if I know that I have a plan in place and if I have a goal that I'm reaching for, rather than this temporary satisfaction of that burger. So once you've set the goal, you've gone over reassessing what's most important to you, you can set that goal, write it down. Again, I'm going to say it, write it down, because writing it down helps you keep you accountable. And once something is written down, we're far more likely to remember it than if it wasn't. Let's get practical. What goals should you be setting? This question is going to vary for each person, but I have a few baseline goals that everyone should have in place. If you haven't, that's okay, but let's talk about them so we can work to that point. Everyone should have an emergency fund of at least 36 months of expenses available in savings or in a high interest account. Money that's accessible. If you can't get to 6 months, no problem. Start with 3 months. And if you're like, hey, 3 months is a lot right now, start with $1,000 and then work your way up from there. That's a good starting place if you don't have any goals and you're like, I'm just trying to get by. If you set small goals and cut out little things that are not the most important to you, you'll get there. And then you'll be able to build on that momentum. Another item to consider is really evaluating debt. So I'm going to say a controversial statement, but it is basically not all debt is bad debt. Some debt can be good, some debt can be bad. Ultimately, good if you have good debt, that can help build wealth only and only if you're disciplined to use it correctly. So an example of this could be a home loan. I know right now doesn't seem likely, and that it could be true. Right now, there's a lot of rental spaces that are going to be cheaper overall than buying a home because of interest rates and the cost of home buying has gone up substantially. But there are good deals to be found, and many of you already have a good debt of a mortgage on your home, say at a low interest rate or that you've had for a while. On the other side of that, though, is going to be that bad debt. And I think probably the first thing that comes to mind for a lot of people is credit cards or high interest loans or personal loans. This interest can eat away at you and can become a black hole where you feel like I'm not getting any progress on this. And you're paying 99% interest, and the balance never really goes down. So my advice would be on that to set a goal to bring it down each month. And once you reach that goal, set a little bit higher of one. Doesn't have to be the whole goal at once. Doesn't have to be, hey, I'm going to pay all this credit card balance, several $1,000s at one time. It's okay. I'm going to pay off chunk by chunk, piece by piece. And then over time, you will be able to carry that through and meet that goal until your next one. As I mentioned before, many of these goals do take time. So do your best not to get frustrated if you don't meet them overnight. However, it's important, as I mentioned before, to set goals that are specific and attainable and measurable. All of these things are really going to help you in the long term build wealth. So let's jump to strategy number three, which is portfolio diversification. So diversification is a term that many of you on here may have heard at one point or another. But again, that's for good reason because it works. And it works especially good at volatile markets. We want to do everything we can to reduce the amount of risk on a portfolio while at the same time maximizing the rate of return. By separating our investments into different areas of the market, we're not putting all of our eggs in one basket and we're not saying everything into one company or one stock or one specific sector because that way it spreads out our risk. It's kind of like if you were to walk on a frozen lake. If you spread out your weight and your surface area, you're able to really minimize that risk of falling through rather than having all of your weight in one specific spot. You're moving it across the lake or across the pond. At Evergreen Financial Group, diversification is at the core of really every portfolio we build, helping reduce risk while at the same time doing our best to maximize the long-term potential that's going to work for each of our clients. There's multiple ways to diversify a portfolio, which we'll jump into here in the next couple of slides. But first, let's look at a real-world example. But as of May 9th, which was at the time of this recording last week, NVIDIA stock has really been the darling tech stock the past couple of years, was down approximately 15.6%, while the Dow at the exact same time, which is composed of 30 different companies, was just down negative 2.7%. It's a difference of about 13%. Now, things have changed a little bit since we have this data, and markets are rapidly changing, but that's a pretty big, substantial impact for difference in those two if you were to look at the value of diversification. If all your investments are in one place, as I mentioned before, you're taking a high amount of unnecessary risk, and you're putting it all on one company or maybe one area of the market. And that's going to be dependent on that company succeeding or failing. And to be honest, if you look back historically of the markets, many times there's been lots of failures for stocks that have been looked, really eye appealing and really, liking like really good stocks to purchase. So if one bad piece comes out about that company, it really could tank the whole stock, and then your portfolio could be gone in the blink of an eye. Sure, it may be hard to see that when all of these really high tech stocks or things have been going up, especially in the last couple of years. However, when they tank and they go down, that's really when you feel the hurt of it a lot more than you feel in the gains. So you're taking a lot of the risk, unnecessary risk off of the table when you're spreading your portfolio across different companies or different areas of the market. The first thing on this slide that comes up, it should catch your attention right away, is diversification can feel disappointing. So if we look at a more longer term example of that, I mean, it's kind of true, but this slide really lays it out very well in explaining how that works. Diversification is not this newest strategy, and it's not what all the financial gurus will tell you what to do. And it's true, a lot of days, some days, diversification doesn't perform as good as, say, NVIDIA or some of those are really hot trading stocks. That's why it's important to look at long-term data and not just short-term data when making financial decisions. So in this case, if we look from the year 2000 right here over to the year 2022, we see the S&P 500 index was down about 40% in that time frame. And if you look at a diversified portfolio, and this diversified portfolio is actually one that's consisted of about 60% stocks, 40% fixed income. So about a 60-40. So a substantially less risky portfolio than the S&P 500. S&P 500 is composed of 500 stocks. And if a diversified portfolio has multiple different areas of the market and different types of investments, not just stocks. So, that's one case in point. I mean, there's so many other examples you can see too. I mean, even if we look at, 2008 down 37%, and then diversified portfolio down 24%. And if you look towards the next year from 2009 to 2019, there's really when you see, the S&P 500 really take off up 350%, and diversified portfolios on the up 195%. That's why it's important to measure data from a long-term perspective, because over time, in this whole period of the last 20 years, diversified portfolio has outperformed just a S&P 500 company or S&P 500, excuse me, index. So there's many examples to really look at. I think diversification in and of itself is a valued principle that we take for pretty high regard here, and that's how I build the portfolios here when I'm looking at all my clients. So if we move on here now and look at different types of diversification. So not only can you have diversification within different companies, you also have different diversification within size. There's large cap companies, there's mid cap companies, there's small cap companies. Basically, how big of a company it is can really determine what type of diversification we're talking about, the size. You can look at industry. There's industries such as tech, energy, utilities, consumer discretionary, things of this nature, which are different types of industries and sectors, which are good to diversify within as well. So just to name a couple of different types within a portfolio, but I mean, we look at different types of asset classes. What I mean when I say asset class, that is a specific area to invest in. So if we look at cash, I think we're all pretty, knowledgeable about cash and what cash is. It's cash. You can put it in a bank account, you can put it on your mattress, things of that nature. There's equity. When I say equity, I mean stocks. That's the same thing. When you buy a stock, you have equity. There's fixed income. Fixed income are going to be things such as CDs or bonds. They're more focused on generating interest, but do not grow as quick as usually an equity would, but a lot less risky. So now we're talking about risk reward type of spectrum here. They're going to be more on the lower risk type as compared to the equities. But over time, they're going to be more stable. There's things such as a REIT, a real estate investment trust, which invests in types of real estate through the market. All of these different types of asset classes are really going to be important for a highly diversified investment strategy. The weightings of these in a portfolio, though, can vary depending on a person's age, depending on a person's goals, depending on what's most important, as I talked about in the first slide of this webinar, really depending on those types of things and can be customized to your specific needs. When we're working with clients here, we talk through all of these different types of aspects of a portfolio when we're building out these strategies that fit specifically. And there's not a one size fits all approach. If we look at it too, we take it one step further. There's also things such as tax diversification across different types of account types. So taxable accounts, as you can see here, are basically accounts that can invest and buy stocks, bonds, any type of investment within, and you can usually take it out pretty quickly. They're pretty liquid type of accounts. The only thing you have to worry about is things such as taxation, but there's a lot of flexibility. There's no limits on how much you can put in or how much you can take out. Retirement accounts, the other type down here, they're really designed for retirement purposes, as in the name, but they can vary in types of taxability. And so that is something to consider when you're looking at how do I pay the least amount of tax? That's also a big part of a financial plan. And each of these do vary, as I mentioned before, on an individual circumstance. That's why it's important to look at how you diversify, not just diversifying within one specific area, multiple areas of your financial plan, not just your investments. And we're moving on to strategy number 4. So strategy number 4 is to reflect on your financial plan. So do you all remember when I talked about and I said the word plan is used a lot in the financial planning world? Well, here we go. It's part of our next strategy. And that strategy is to reflect on your financial plan. What is a financial plan? Financial plan is going to be your vision and your roadmap so you don't get lost, to guide you on the tour, on the road trip, on the journey to building wealth. So similar to our slide of setting a goal, this plan takes that, really amplifies it. Financial plan can encompass many types of goals. It can be one goal, but it usually is many types of goals that you're working towards. And it's overall a shell that will help you reach those financial goals you have, as well as how to get there in the most effective and efficient way as possible. When I was younger, we did a lot of traveling and we used to have an atlas, pretty much a map, a big map that we used to have before GPS and all of that. That was our way to navigate travel from point A to point B. And there's multiple ways to get there, but many times we want to go from the quickest route from point A to point B most of the time, because then it's going to get us there quickly, it's going to save gas money, it's going to, work out in our favor usually, unless we want to take the scenic route, which is also an option. But when it comes to financial planning, it's very similar. We're at point A, and your goal that you have, or multiple goals, is point B. And that's the job of the financial plan, to get you there the most quickest way possible. Unless you're wanting to go off and, take the scenic route, which is an option, but most of the time in the financial world, usually doesn't make the most sense to do that. We usually want to build wealth the quickest that we can. So while we can't, predict the next market downturn, we can prepare for it. With a solid plan, we're not just bracing for the impact, we're positioned to take advantage of opportunities that arise during market lows. If you don't have a financial plan in place, that's okay, but now's the time to get one in place. I'd recommend to work with your financial planner. Working with one can really help you figure out what this looks like based on your specific needs, income, based on your goals, based on everything that you have happening in your specific life. So, staying on this once more here, let's talk through what a financial plan can include. This is just a small example, but things such as income, how much money you're bringing in, cash flow, spending. On the other side of cash flow, how much are you, spending out? Taxes. This is a big one. With a lot of changes in tax code happening, we want to make sure that our clients pay the least amount of tax as possible for their given situation. And that is based on a whole lifetime of them. Unless you really want to pay more tax, which some people do. Um, but in most cases, I would say we're wanting to keep a lot more of that wealth for ourselves and for our families to reach our goals. Along with that, debt, as I talked about before, what's the most efficient type of debt? Is it good debt? Is it bad debt? Does it depend? That's part of the plan. Retirement. And so retirement planning is pretty substantial. A lot of people just work, work, work until they, had a point and they say, hey, I'm going to retire. So that's also a factor that comes into play. All of these are just, little pieces of the puzzle when we're talking about a financial plan. There can be more as well. If you look at the graphic, I don't have a couple of these in here, such as medical and health, insurance, things of that is important. Child's education, education planning, if you're wanting to save to, um, you know, pay for education of a family member or a friend. Insurance, those are also things to consider and all included in a financial plan. So if we move on from here, let's talk about our fifth strategy today, and that is to stay the course. We've defined a course already, and we like to call that the financial plan, things that we've talked about. So now what we have to do is stay on it. And it's not as easy as it looks, but it can be. So you've likely heard the term time the market, or you've heard it if you've been around finance at all, you say, hey, timing the market is the only way to make money. It's the only way to be able to react, or the only way to be able to build wealth. The rarity of that is very few people do this successfully. And even more rare, the ones who are continually doing it over time. So while, if you're able to buy at the lowest point in the market and sell at the highest point in the market, you're going to make a lot of money doing that. But most of the time, what happens is you can't predict that, because all of the things that are happening within the stock market, all the things that are happening within the economy, different tariffs, different taxes, different savings, all of these things are part of the plan overall when it comes to your full economic picture. So what happens is when you're trying to guess the market's next move, often leads to poor results, can ultimately lead to you losing money and getting in a worse situation than where you started. Many of the talking heads out there will tell you that you have to time the market to make money. What really matters the most above that is time in the market is going to matter far more than trying to time the market. Over here on the slide, if you guys remember 2020? So a time that is time that many people want to forget, but that was in COVID-19 when, in regards to the stock market, the Dow fell 37% in 2020, the first few months of 2020. So if you remember that, if you look at this graph, you say, hey, in the top of this graph, the orange are the positive years on a yearly basis, and the yellow right down below it are the years that are negative in the stock market. So what we're seeing on this, if you look to year 2020, There's orange and what's just above the line. And but you're telling me that the stock market was down 37%. Both of those are true. In the same year, the Dow being down 37% in that year, um, it actually climbed to substantial highs and actually beat that historically over time later on that year, and it was a positive year for 2020. And you wouldn't be able to see that. You wouldn't be able to tell if you're just looking at it and say, "Hey, great year for 2020. I wish I was invested." During the midst of it, you would have said, "Oh, I don't know about this. Maybe I should sell." But even today, despite recent volatility, it's still up 101% from that low back in that year. So if you're to sell your portfolio and really drift from the course during those down markets, you would have missed out on substantial gains that happened a few months later, shortly down that. And if you look at the history of the market and investing for the long term, you can see that there's a lot more positives on the top than there are negatives on the bottom. But what ends up happening is the negatives on the bottom affect us a lot more than we see the positives on the top, and we get scared and we want to sell. What ends up happening is we take our money out in these downturns and we say, okay, let's wait. Let's wait until all of this volatility subsides, and then we'll buy back in once there's more stability in the market. What usually happens is we're selling usually close to the low spot when the market's already dropped because we've missed that. And we wait for things to calm down and become more stable, and then we buy back into the market. However, we usually buy back in at a high because things are more stable and we say, okay, we're good with that. But the stock market's already gained a substantial amount since that low. We've missed out on some opportunity over time. We stay invested in the long term. That's really where the biggest gains end up piling up. So, even looking at this historical graphical example, it's really easy to see that most of the down years, the years following that, really exhibit exponential growth. It's only a couple times in the history of markets where we've had multiple positive, or excuse me, multiple negative down years where the market hasn't recovered substantially quickly after that. So let's make this practical. So this example right here is a strategy that is called dollar cost averaging. What dollar cost averaging means is specifically, or I should say consistently, investing a fixed amount into a brokerage account or into the market, or saving an amount over time. Pretty much just putting away money. So this one has you saving $100 a month, starting at age 25. And that doesn't have to be age 25, depending on, what the age of it that you're watching is. It can be different ages, but this consistently has $100 a month. So you start way down here and then you end up way up here. So this green line is pretty much the money value of your contributions over time that continue to build. And this line over here on the left is going to be the growth that happens. And you may look at it and say, well, that's consistent growth over time. This strategy in itself is basically predicting a 7% annual average return. So if you look at, just say, the S&P 500 as an example, that actually is lower than the returns we've had seen on average, 7%. Right now, we're seeing the returns overall in the longer term that are above that, 8 to 10%. So even if you do have bad market years, say, in one of the years when you say, I just wish I didn't invest that, or I don't want to invest when times are down. What happens is over time, within that, you see the compounding growth that'll happen substantially if you stay consistent with what you're doing. So by continually investing over time, not giving up and not getting scared of what's going to happen with the markets and selling out at the bottom, that basically will allow your money to compound and you'll be able to stay consistent. Let's look, for instance, on S&P 500 on Monday of this last week. It rebounded 3.26% in one day, which is almost half of the return that I have built into this overall graph right here, just to show you an example. So I say that to say everything happens quick. And if you're missing out on a couple of really good days in the market, that's going to have drastic impacts in the long term. By staying in this course that we've built out, this financial plan, you're ensuring you're not purchasing everything at the top of the market. Yeah, downturns are uncomfortable. They really are, and they suck to see the red in your accounts. But staying consistent helps you buy low and benefit from long-term compounding growth over time. I have one bonus tip here. That bonus tip is going to talk about 401k contributions. So that's pretty good example, similarly to like a dollar cost averaging strategy, where you're pretty consistent over time if you're contributing to, say, your 401k or IRA, because it can come out of your paycheck. Many times, some of your employers that you're working with offer a 401k matching contribution if you elect to deposit a certain amount into your accounts. By stopping these deposits, the employer will also stop their contributions into your account too. So if you're saying, hey, I'm going to wait, I'm not going to put money into my 401k, I want to have it in my pocket a little bit more, I just don't feel comfortable investing it. Not only are you giving up potential gains you could have on your portfolio in the long term, you're giving up the money, the free money that your company is giving you in order to meet your or exceed your deposit you're putting in. So you're giving up free money in multiple areas when it comes to that. So another thing to consider over time when markets are volatile is how much am I actually giving up? All right, well, that covers, the five strategies that I had here for us today, but let's talk about some final thoughts and takeaways. So big thing I want us to remember is while we can't control the economy, we can control how we prepare for it. Economic uncertainty is always going to be around in some capacity. No matter how many years you've been alive to see markets go up and down, or even more recently, you're going to experience it in some capacity. What matters the most is how we react to it and how we prepare for it. That'll be the difference in building the long-term wealth. By focusing on what we can control, setting these realistic and attainable goals, diversifying strategically and very smartly, having a solid financial plan in place, and staying the course of that financial plan over time, you're not just surviving uncertainty, you're building resilience and setting yourself up for success in the long term. So I would like to open it up for questions. If anyone has any, let me just take a look and see if we have any questions coming in. All right. I think we do have a couple. So the question is, I have cash right now and I'm waiting on the right time to invest it. Is now the right time? I think that's a great question. And I think many of us wonder what the right time is. But as I just recently talked about, um, it doesn't. Time in the market matters a lot more than timing the market. Ultimately, this is going to be a conversation that should be had between you and your financial planner. Every situation is a little bit different and depends on your overall goals. However, a good question to ask yourself would be, what is this money going to be used for, and when's it going to be needed? That answer can determine a lot if you want to invest it, if you want to keep it, depending on how your strategy is going forward, what the purpose of those funds are. With that being said, a general tip I would recommend is to not overthink much about the timing. Like I said before, timing the market matters more than trying to time the market. And that's going to be the most important thing going forward to consider. Depending on who you talk to, they'll say, no, you didn't put it in now, no, you need to put it in later. Of course, we always want to, buy low, sell high is the ultimate strategy, I would say, over time. And everyone's going to tell you that. But the part of executing that over time is where our human emotions can come in and where we can get distracted from the plan that we have set in place. But again, I would recommend having a conversation with your financial planner to determine the right strategy for you. Let's see here. All right. This is a good question. What impacts do tariffs have on the market? I'm nervous about how this will impact my portfolio. I mean, with all the relevancy of this question, I think it's very great because there's a lot of change that's happening right now. And as you've all seen, there's quite a bit of volatility. Depending on when you're watching this, it could be different depending on when you see it. But as of right now, in this moment in time, there's been a lot of things happening in the tariff world. And I will say to this, a lot of what's happening, a lot of the volatility we're seeing has been contributed due to the fact of uncertainty. So similar to talked about, uncertainty in markets. The stock market in and of itself really doesn't do well when it comes to a lot of not clarity, I should say, on that when it comes to just not knowing what's in there, what's law, what's not law. With all the tariffs and talks being thrown around and deals and whatnot happening, a lot of the drop we saw was due to just not being sure of what was happening. It's like, is there tariffs? Is there not tariffs? And that's how I would say where a lot of the uncertainty can come into play, rather than the news of actual tariffs themselves. There's really a lot of speculation on what was going to happen. But when things were more solidified and people understood a little bit more, there was a lot less selling, a lot less panicking, I would say overall, because things are more solidified and markets have balanced out quite a bit, even with the tariffs that were higher than expected. Additionally, I will say tariffs are only one piece of the puzzle. There are a lot of factors that affect a share price than one thing. When that's some sort of news hits the scene of like tariffs were really big recently, there hasn't been, it's really taken away a lot of the tension from the interest rates that we have, once heard about. All of those factors are important. So really looking at all those factors are important, I should say, when it comes to volatility in markets and how markets react. So when looking at the markets, I would advise to look at more of a longer term perspective because my first strategy, because we've talked about as much of the volatility fades, um, the longer the time frame you have to look at, you'll see less volatility over time. And understanding that short term volatility, you know, should hopefully go away as more economic data becomes available as we're seeing more. Again, there's always going to be market volatility, but this question also is really good to review with your financial planner to ask about your specific situation. So please, yes, reach out to your financial planner or advisor and they can help you out. All right. Let me see. Well, I think that kind of wraps up our time here today. And thank you all so much for joining in today. Really appreciate you taking the time to listen in. I hope you got some good strategies or tidbits out of this. Again, if you're not working with a financial planner, we would love the opportunity to talk with you about how we can help. You can scan this QR code on the screen here to get in touch with us, to go to our website to learn more about how we do business and how we work with our clients. We specialize in working with many types of individuals. We just love helping others who want to, accomplish their stewardship goals. If you're an existing client, we'd love to hear your feedback. And if this was helpful today, or if there's any other topics that you would like us to discuss. But again, every situation is a little bit different and does depend on your overall goals. And that's where we recommend talking with your financial planner. Thanks so much for tuning in today, everyone, and reach out if any questions arise. But we will be talking with you soon. Thanks so much.